Welcome back to Switzer and Australia's business channel. Paul Rickard is the former CEO of CommSec and was a career banker and one of the earliest advocates of buying banks as a solid dividend play. But is he falling out of love with his beloved bank stocks? And is he finding the courage to punt on Santos? Let's find out. Paul, thanks for joining us.
Thanks, Peter.
I always like to, rub in your history as a banker, and we're going to talk about bank stocks in a moment. But I've had a viewer who's been terrorising me over a question, which I've promised to answer 2 or 3 times. I can see why he's terrorising me. And he was asking about the amount of extra saving people are doing by paying off their loans. Yep. So tell us about what the Reserve Bank is saying about
Yeah, well, typically what happens, Peter, is that when interest rates fall, the loan amount doesn't adjust and people don't actually reduce the amount of their mortgage repayment.
Yep.
I think we've got a chart on the screen in front of you, which hopefully you can see, which is a chart the RBA put out just last month, which shows a pattern of excess payments.
Are the blue ones the excess payments?
Yeah, and the lighter colour, of course, this is a matter of looking at mortgage payments that people are making every month, and the lighter blue colour is what's the normal amount. That's the standard principal amount. And then the purple amount is the excess payment. In other words, people are paying a lot more than they need to on their home loan. And that's because about 80 or 90% of people, when interest rates fall, they typically don't ring up their bank and say, I want to pay less. Yeah. The payment remains unchanged. And, of course, they just get ahead of the schedule. So, look, this is one of the reasons why all this fear about the housing bubble and all the nonsense about that. Sure, housing prices could change, but
that's a big buffer of safety, isn't it?
It's a huge buffer of safety.
Yeah.
There's another stat the Reserve Bank put out in its last bulletin, was about looking at the amount of money in excess and offset accounts and also in redraw facilities. Yeah. And it's something like about 16% of the total mortgage outstanding. So there's almost 2 years' worth of repayments. Yeah.
So it means that banks are really safer than we thought because their customers are safer.
Well, look, I mean, I think the risk to a bank from the property market is not, weaker housing prices. It's always been about unemployment. Yeah. And that takes a couple of years to build up. So, look, I think people will worry about this stuff too much. Our banks are very
Christopher
safe.
Joy and people like that.
I think Christopher needs to have a look at some of the stats. I mean...
this will get him going.
This will get him going. I draw him to the Reserve Bank's Financial Stability Bulletin pretty much.
Because the Reserve Bank's not as worried as Christopher. OK, let's get at the other part of the banking story. You want to talk sectors first?
Yeah, I want to just look at what's going on in the market so far this year. And again, we've got the major sectors across the ASX 200, both for the month of April. Yep. And on a year-to-date basis, this actually looks at dividends. So so far this month, the market's down just 1%. Yeah. Year-to-date, it's almost still up 9.3%.
Terrific,
so
really.
People are doing pretty well. Yeah. What's interesting is pretty well every sector is just marginally down during the month of April. Yeah. But, of course, energy, where we're talking about names like Santos, has had a really big rebound.
I look at consumer discretionary too, Paul, 12.6%.
And on a year-to-date basis, the best sector is still financials.
Funny that, isn't it? The one that all the experts were bagging a year ago and 2 years ago, they keep performing.
Yeah, and even in the month, it's only down the market index. So, look, I think what we're seeing in the macro themes that have been taking place in 2015, very much a repeat of 2014. This is still all about yield. It's all about the yield sectors in terms of the financial sector, the utility sectors, telecommunication to some extent, plus a lower Australian dollar and the sectors or stocks that can benefit from a lower Australian dollar. And those themes, lower interest rate, what it means for the yield gap, plus a lower dollar, what it means for some companies in the health sector, industrials and consumer discretionary, those themes haven't changed.
What's also interesting, that materials are actually up 5% this year, despite all their problems with the iron ore price. They're doing OK.
They are up. Look, we've had a pretty... Look, I think any investor in materials has probably done it pretty tough. Oh. And it's not a sector I think you want to be overweight in, because I think there's still struggles in that sector. But it's not as bad as it looks. No. As
Let's go.
BHP and Rio are now sort of almost dividend payers.
Well, that's an interesting part. Now, but your beloved banks, what's your view? Are you breaking up the banks?
I'm not breaking up. I think it's
hard to do, Paul.
It is hard to do. I've been very overweight, and if you look at the sort of the financials index, take away property trusts, it's worth about 42% of the market.
Huge.
So I've been very overweight. I've pulled it back to moderately overweight. So I'm still a fraction overweight.
Okay, but you're not adding new financial.
I'm not adding new stocks, and I still think you let the market go because, the odds are, as you were talking about earlier with Martin earlier, I still think that the chances are another rate cut still on the agenda at some stage. We'll know probably more from the minutes tomorrow, as he said. And in that case, it's still very hard to get rid of these high-yielding bank stocks. Yeah. Maybe it's time to look at the mix. Macquarie's had a great run in the last 3 months. AMP and some of the other Challenger have probably... I've changed the mix out of the major banks a little bit, but it's still hard to really break up just yet. You just got to let this stuff go.
But is there a small financial institution you've actually lent on more heavily?
No, I think I'm taking a bit of a contrary view to the market. I think the smaller institutions have had a good run last year. So the Bank of Queensland's Bendigo's had a great run last year. I think now that interest rates are where they are, the market where it is, a lot of that evening up for the playing field has actually occurred. I think you still look at the major banks, and they're managing their cost bases pretty hard. So, look, as long as they can have a bit of revenue growth, there is no risk to bad debts at the moment. There is no problems in the housing market. Unemployment's not about to explode. It's very hard to see how the bad debt cycle is going to turn around just yet. Dividends and returns will remain healthy.
Okay. Now, I know last week you were talking to me off camera that you're getting more interested in Santos. Since then, a number of articles coming out saying Santos is looking better. I know Martin Lakos said to me before I came on, Macquarie likes Santos now. What's your view on Santos?
Look, I got very close on Santos. I looked for it to touch $7. It went below $7. I missed it on the way up, Peter. I just got a little bit greedy, as you do sometimes. Now today, I think it closed at $7.94. So it's come back. It's had almost a 15% rally from its bottom. I think it's in the buy territory.
The trend looks good for you.
The trend looks good. Maybe there's a bit more weakness to come, just, because it's had a very quick rally. And I think it's for the bold and for take a not a 6-month view, but a 2 to 3 year view. I think there's probably some value in some of these oil companies. Yeah,
because you don't suspect that OPEC will play this game forever, like you don't expect BHP and Rio to play their game forever at some stage. Because it's interesting.
We think at some stage common sense will prevail. I mean, OPEC will come back to where it wants to be, and BHP and Rio will eventually stop this mad production.
It's very interesting. Twiggy Forrest said that if they did cap their production where it is now, that the share price instantly would go, so the iron ore price would go back to $70, maybe $90, because a lot of it is inbuilt pricing, is it, on the basis of what's happening to supply. If they were able to create a acceptable cartel, iron ore price would go up and the share price would go up.
We can't, of course, talk about cartels, but that's breaking the law. But I think we all know what question about in Australia's best interest. I think, as I mentioned last week, the worrying thing for BHP and Rio is not so much the supply sides of the issue, but also their demand forecasts. And, there's BHP in its most recent presentation is still talking about, Chinese steel production of about 1.1 billion tonnes, peaking somewhere between 2020 and 2030. But, Professor Garner came out last week, and there are others talking about more that it might peak at about 800 million tonnes and it'll be 600 million tonnes by 2030. So there's a big mismatch between what some of the iron ore producers are talking about in terms of actual demand and what actually a few of the other commentators are talking.
Yeah, without a doubt. OK, Paul, that's it. We're out of time. Thanks for joining us.
Thanks, Peter.
Paul, of course, is a star writer on the Switzer Super Report. OK, so our next little story will be about Quest and a Singaporean company that's taken an interest in this Aussie company.